Okay, I want you to picture this for a second. We're standing in the darkness of ancient Mesopotamia. We're talking 5,000 years ago. Now, obviously, people back then weren't borrowing dollars, euros, pounds, or rupees. Instead, they were borrowing grain right before a harvest, or maybe some silver and livestock to finance a really long trading journey. But here's the absolutely fascinating part. Long before physical money or coins even existed, humanity actually invented credit. And with it, this one strange, totally invisible rule was born, a rule that has somehow survived every single civilization, every empire, every religion, and every financial system since. That rule: if you borrow today, you must return more tomorrow.
But, why? Who actually decided that time should have a price? Was interest just invented by modern Wall Street banks? Was it cooked up by ancient governments? Or did it emerge completely naturally, long before the invention of money itself? Honestly, the deeper you investigate this, the stranger it becomes. Over the centuries, interest has been condemned as entirely immoral, it's been fiercely defended as absolutely essential, and it has quietly shaped kingdoms, built industries, sparked revolutions, and basically engineered the modern global economy. So let's dive into this 5,000-year-old mystery. Now, before we uncover the actual mechanics behind the price of time, please note, this explainer on the channel Blockspawn's Funds is created for educational and informational purposes only, and does not constitute financial or investment advice. All right, so to really understand modern finance, we actually have to travel back those 5,000 years to the temples of Mesopotamia. Long before commercial banks were a thing, farmers were borrowing seeds, merchants were financing their trade journeys, and literally entire communities were depending on future harvests to survive. And as our sources point out, we don't even know precisely when interest-bearing loans originated. Why? Because they actually predate writing. That's how old this concept is. But historians generally believe that temple administrators first invented the idea to finance the caravan trade. Basically, they advanced goods to local merchants and then just took a share of the resulting profits. The absolutely crucial point here is that interest existed way before modern banking, because the true commodity being exchanged wasn't money, it was time. And what's just staggering about these early origins is the sheer scale of the interest rates. Around 1750 BC, King Hammurabi of Babylon set down the earliest known formal code of laws, and a huge chunk of it was dedicated to regulating debt. Get this, Hammurabi's code set a maximum interest rate of 33.33% per year for loans of grain. Over 33%. And these agreements weren't just casual handshakes either. They were meticulously recorded on clay tablets, sealed, and officially witnessed. If a lender tried to charge more than the legal limit, the entire debt was just canceled outright. It's a brilliant illustration that modern finance, complete with written contracts and consumer protections, literally began with ancient promises pressed into wet clay.
So, from Babylon, the concept of credit naturally spread, but it certainly didn't go unchallenged. Not at all. For centuries, the practice of charging interest, which was often called usury, became the center of this incredibly fierce ethical and moral debate. What started out as a legally enforceable Babylonian contract transformed into a really profound dilemma in ancient Greece, in Rome, and all throughout the Middle Ages, in Christian, Islamic, and Jewish jurisprudence. Societies were constantly swinging back and forth, right? Oscillating between permitting interest to help fund economic growth and then prohibiting it entirely to prevent the exploitation of the poor. And the philosophical pushback? It was intense. The great Greek philosopher Aristotle famously argued that money is barren and cannot reproduce value on its own. Basically, he believed that natural wealth came from agriculture or physically making things, whereas just making money from money, that was unnatural. Now, he was a genius philosopher for sure, but maybe not the best investment banker, right? Still, this Aristotelian view heavily influenced the Middle Ages. The Christian church viewed charging interest as a sin of greed, and in Islam, strict prohibitions were established against it to prevent societal exploitation. So for centuries, charging interest was seen largely as a deep moral failure rather than any sort of economic necessity. But
As the global economy continued to expand, pure economics began to replace that philosophy. To understand why interest actually survived all these bans, we have to look at a concept called time preference. Think about it this way. If I offer you $1,000 right now, today, or $1,000 10 years from now, which are you going to choose? Right, nearly everyone chooses today. We as human beings are completely hardwired to value present consumption over future consumption. We want things now. Therefore, if someone is going to delay their own gratification and lend you their resources, they require compensation for that waiting period. Interest, at its absolute core, is simply the premium paid to overcome human time preference. And this brings us right to another invisible force: opportunity cost. When a lender hands you capital, they aren't just sitting around in an empty room twiddling their thumbs waiting for you to pay them back. Capital branches out into countless potential futures. They could have used that wealth to go buy land, start a new business, or maybe fund some revolutionary invention. By lending to you, they are sacrificing every single one of those other alternatives. So interest compensates the lender for giving up those possibilities. You are literally paying them for the opportunities they missed out on while you were busy using their resources. So how in the world do we actually calculate the price of time? Well, modern financial theory basically deconstructs an interest rate into a stack of invisible building blocks. When you see an interest rate quoted at your local bank, you're not just looking at one number. You're actually looking at several different prices all merged into one. The three foundational blocks here are the real risk-free rate, the default risk premium, and the inflation premium. Let's break these down one by one just to see exactly how economic risk is priced into time. All right, layer one is the real risk-free rate. I want you to imagine a perfectly certain world, a world with absolutely zero inflation and zero chance that the borrower will fail to repay you. Even in this impossible financial utopia, an interest rate still has to exist. Why? Well, because of that time preference we just talked about. The real risk-free rate is your baseline. It's the pure rate of compensation required by lenders to simply postpone their current consumption. It is the raw, unadulterated price of waiting. But obviously, we don't live in a perfectly certain world. The future is entirely unknown, and that's exactly where risk enters the equation. Everyday individuals, giant companies, and even governments borrow under conditions of massive uncertainty. Some are going to repay faithfully, and others are going to default. Because lenders know they might just lose all their money, they demand a default risk premium. Basically, the lower their confidence in the borrower's ability to actually repay, the higher this premium gets pushed up. This is exactly why a brand new, unproven startup has to pay a much higher interest rate on a loan compared to a massive, stable government. Interest doesn't just reflect time, you see, it reflects trust. And now for the third, and honestly, perhaps the most insidious layer, the inflation premium. Year after year, inflation quietly erodes our purchasing power. If a lender gives you enough money to go buy a car today, and then you pay them back that exact same dollar amount in 10 years, they might only be able to buy half a car with it. So to protect themselves, lenders stack an inflation premium right on top of the interest rate. They estimate exactly how much they think prices will rise over the life of that loan, and they charge you for it up front just to preserve the underlying value of their capital. Now, putting this all together leads to a massive realization for anyone trying to manage their money, which is the difference between nominal and real interest rates. The nominal rate, that's just the sticker price. It's the shiny number the bank quotes you. But the real interest rate is what actually determines your future purchasing power. Look at it this way. If your savings account pays a 3% nominal interest rate, but inflation is running hot at 4%, your real interest rate is actually negative 1%. You are literally losing purchasing power every single day you keep your money in that bank. As our sources highlight, deeply understanding this equation is absolutely crucial, especially during times when inflation is highly volatile. When we zoom out from all of this, we start to see that these stacked invisible prices, time preference, opportunity cost, default risk, and inflation, they form this massive interconnected global credit engine. We're talking about rivers of credit connecting households, businesses, commercial banks, and entire governments. Every local mortgage, every corporate bond funding a new factory somewhere, and the trillion-dollar government debt markets are all driven by this exact same framework. Central banks manipulate these base rates to either speed up or slow down the economy, effectively directing the flow of capital that literally builds our civilization. Cities, bridges, hospitals, and technological innovations, they only exist today because someone, somewhere, made the choice to sacrifice their present resources for a greater value tomorrow.
Which really brings us to the central realization of this entire explainer. When you walk in and take out a loan, you probably think the bank is charging you a fee for handing you some paper bills or typing some digital digits into an account. But you are not paying for money. You are paying for time. You're paying to fast forward your life, to live in a house today that would have otherwise taken you 30 years of saving up to afford. Interest is the invisible mechanism that literally allows us to transfer value across the fourth dimension. I want to leave you with this really profound thought. Interest is the economic language through which civilization values time. Think about the flow of it all. Human effort becomes money. That money becomes credit. And that credit becomes civilization itself. If interest is truly the price of time, then every single loan, every savings account, and every bond in the global economy is actually just a contract through which time itself is being traded. So think about that the very next time you look at an interest rate. Ask yourself, are you buying time or are you selling it?